Interest rates have been rising rapidly recently, and if you've got a mortgage, this is not ideal. We've done a podcast on that. But if you've got some cash savings, then this could be the first time in about 13 years that you could start to get actual decent returns from cash savings. So today, I thought we would talk about what are the options where you could store some cash savings. And the reason we're talking about that is because you have some cash savings at the moment, which is basically money that you've saved up in order to pay off your Help to Buy ISA. Is that right? Not Help to Buy ISA.
Yep, not I say. I've helped to buy a loan. That's it. Yep. So
Yeah.
I'm going to try and repay that soon.
Okay, so we're just going to chat through it because we chat through things all the time off the podcast, and we're going to try chatting through it on the podcast.
Mhm.
Also, Matthew, our podcast editor, is away, so we weren't supposed to do a podcast this week, and that means we're going to be editing it ourselves, which is like the bad old days when we actually did used to edit ourselves. So this could be pretty ropey.
Yeah, and when you say we, you mean you.
Exactly.
It would be really bad if I did it.
And then we normally put the intro in, but we'll just do the intro ourselves. So I'm Dr. Tommy Perkins. I'm a GP and co-founder of Minix Money.
Yep, and I'm Dr. Ed Cantelo, a salary GP, and also a co-founder of Minix Money, but also an accountant and a chartered tax advisor.
Are you going public on your new qualification yet?
Oh yeah, I've also got a diploma in financial advice, a DIP-FA as well. Well, that in March, I think it was all.
Which means that you could also be a financial advisor as well.
I think so.
Which is absolutely bonkers. I have nothing like that. And then we have to say something about tax allowances and rates subject to change. This isn't financial advice. Do your own research.
Yeah.
Disclaimer. All right, disclaimer inserted. That means I don't have to do it in the edit. So the less editing needed, the better. No pressure. But yeah, so basically, imagine you have some cash right now. What we're going to do is just go through some options that we can think of effective places to store it. But we've been getting a few questions on our Instagram, on our YouTube comments, and we're on Threads now as well. I'm going to assume you don't know what Threads is. No offense.
No, I do actually. I mean, because I read the papers, not.
Apologies. Yeah. Apologies, sir. About basically saying, is cash, because I've been saying cash is trash for a long time. And what I mean by that is that historically, cash is not an investment, okay? So if you've watched our YouTube video, you've already seen this graph, but I'm now going to attempt to do a screen share. Oh, this is not going to go well, is it? Because we need this to be a smooth edit. Okay. Oh, I think it's worked. Okay. So hopefully you are now looking at a graph which shows the returns of investing £1 in 1900. In the green line is equities, which is stocks and shares. The blue line is bonds, which is essentially buying other people's debts, and cash, self-explanatory. Okay, so this is why, historically speaking, cash is not an investment, because as you can see from this line, if you invested £1 in 1900 in stocks and shares or equities, you would have £386 today. If you invested that £1 in 1900 in bonds, you would have £4 today. And look at that tail off in bonds in the last sort of 2 or 3 years. So at the end of the graph there, bonds have been getting hammered. And if you invested £1 in cash nearly 122 years ago, you would have just £2 today. Okay, so past performance does not indicate future returns, but that is why, in general, I do not hold much cash, because it is getting destroyed by inflation, and historically, cash has not been a great investment. So you're like, okay, how long could I invest for? Say you've got some money and saved up. For your example, right, you've got this money saved up and you need it inside the next 5 years, yeah? Mm-hmm. And if you go to see a financial advisor, they will say, okay, if you need it within the next 5 years, you probably should not invest it in equities, mm-hmm. despite what I've just said. But what is the reason for that? Well, again, if you've watched our investing videos on YouTube, you will know the reason, but here is hopefully another graph which shows why 5 years is suggested as the minimum term for investment. Because basically what this graph shows is that the longer that you invest for, the less chance you have of losing money, okay? But if you invest for 1 year, you've got actually a reasonable chance. And this is all historical speaking, okay? So using stock market returns from 1950 to 2022. Okay, that's not even getting edited out either. Oh man, this is punishing with having no editor. But anyway, that's the gist. That if you do it for a year, the risk of losing your money is actually reasonably high. But if you do it for 5 years or more, the risk gets lower. So basically, if it's really short term and you need it in the short term, investing it in the stock market, probably not a great idea. But then you're like, oh, well, what am I going to do with it? Because if I keep it in cash, inflation's destroying the value of it. And then the other argument that I keep seeing at the moment, and you'll see this argument forevermore, is that, oh, it's not a good time to invest at the moment. Okay, so let's imagine you have got more than 5 years time frame. You don't need the money for more than 5 years, but you're like, oh, inflation is high. There's a war in Ukraine. I'm going to wait to invest because it's not a good time to invest. Well, this is the graph of a major stock market indices, in this case, the S&P 500 in America, mapped to a whole wealth of world events. So we've got the Gulf War on there, we've got the dot-com bubble, we've got the global financial crisis, we've got the coronavirus crash, okay? And despite all of these awful things happening, in the past, historically, it's always gone up and to the right, okay? So my point here is that there's always doomsayers saying, oh, it's not the right time to invest, this time it's different. Well, if you think that this time is different, you might be right, but just have a look at this graph and ask yourself, probably there were people sat around during the Black Monday saying this time it's different and they didn't invest for 10 years. Well, they lost out on an awful lot of gains doing that. So does that make sense?
Yep, absolutely.
Got any questions?
No, I remember Black Monday. It was around the same time as a hurricane in the UK, I'm pretty sure. And my fence blew down. Well, so mine, my parents' fence blew down. Anyway, little aside there for you.
Do you remember the Iranian oil crisis?
No, I was like 4 at that point.
Oof. Yeah.
And I don't remember, before you ask, the post-Korean War recession either.
Which was in 1953 or 4?
Yeah.
Yeah. But pretty much, I remember over half of this, which is a bit disappointing because we're getting old. Anyway, let's not mull on that.
Yeah.
Okay, so you've got this money. You need it in the next 5 years. So you've decided that you're not going to invest it because of the reasons that I just outlined. And that is not investment advice. I'm just pointing out what the numbers say. Okay, so where could you store this cash? And basically what you're saying is you need this cash to be liquid, right? Which means at any one point, you need to be able to go and get it. Okay, and if it's in an investment and the stock market is down, then you're going to lose a ton of money. So it needs to be somewhere liquid. So the most liquid place that I can think of for storing money is in a bank account. Just put it in the bank. And historically, over the last 10 or 13 years, interest rates were really, really, really low. And so that wasn't really a viable option. I'd argue that long term, it's still not a viable option because of the chart that I just showed you. But short term, interest rates are a lot better now. So I think that's a reasonable option. And the pros of that are it's reasonably secure. So you might be aware that you can have up to £85,000 protected. I think it's called the Financial Services Compensation Scheme.
Yeah.
So basically, if your bank goes bust and you've got less than £85,000 in there, then you're guaranteed to get that money back. So it's reasonably secure. And if you're thinking that sounds unlikely, well, you might be aware that Silicon Valley Bank in America had a bit of trouble recently. And I'm sure you are old enough to remember Northern Rock.
Yep, yeah.
So, yeah, the obvious downside of storing it in the bank is what I've just talked about, really, isn't it? That if the bank's paying you 4% interest and inflation is 8% or more, you are still losing at least 4% on that cash, which is a very challenging place to be. But the other thing that I wanted you to explain in a bit more detail, if possible, is how you get taxed. Because if you put that money in the bank, you get interest. How you get taxed on that interest, because this could be a con for high rollers, basically, or higher earners.
Yeah, no, absolutely. So it always used to be the case that your interest income was just added to your other income and then taxed usually at your marginal rate. So in the old days when I was studying at PwC or studying for my exams, you take your employment income, tax that, and then your bank interest, tax that, then dividend income, and so on. But in around 2016, they introduced some new rules which said that if you're a basic rate taxpayer, you can earn up to £1,000 in interest without being charged income tax. Okay, so you get £1,000 sort of savings allowance, basically. And if you're a higher rate taxpayer, you have a £500 allowance. And if you're an additional high rate taxpayer, you have no allowance whatsoever. So you'll just be paying 45% tax on your bank interest. Okay, so it was introduced, this £1,000 tax-free allowance or £500 for high-rate taxpayers. It was basically introduced to try and spare most people from having to pay tax on their interest. But again, like everything else in the world, in the UK, they've not increased that threshold since it was brought in 2016. So because interest rates are kind of rising, they actually think that 1 million more Britons will start paying tax on their savings this year. So definitely worth watching out for that, because you may just not realize that if you didn't know. You pretty worked on the basis that perhaps because it's been tax-free before, it's always going to be tax-free. But actually, with the rise in interest rates, just bear in mind that you may actually potentially fall above those income thresholds.
Yeah, good knowledge, good tax knowledge. And I guess that interacts with something that I'm going to mention in a minute, which is a cash ISA. Because if you are in that higher rate band and you are going to get stung by this having cash in the bank, you could consider putting in a cash ISA where, of course, it would be tax-free.
Because I've got some numerical example, so I might help.
Love it.
So if you think about, if you had £100,000 in the bank account, you'd basically need £100,000 at 1% to pay any savings tax if you're a basic rate taxpayer. But if currently in 2023, if you have, I think here are the numbers, £38,461, now interest rates are higher, let's say it's 2.6%, that will mean you'll start to pay tax. Okay. So, a long time ago, if you had a interest rate 1%, you'd need, £100,000 to start paying tax. But now, if you've got 38,000 in savings, with the interest rates being what they are, that's going to trigger a demand from HMRC. So the point is, interest rates rising, you're going to be much more likely to have to pay the savings tax.
Yeah, definitely. I think it's always good to keep your finances under regular review, but there's been so many changes recently, like within tax, within the annual allowance for the NHS pension, with interest rates, that you've got to be hyper vigilant at the moment because there's so much going on. But that is awesome knowledge. So just pointing that out, don't get stung by that tax trap. So what I was talking about before for putting it in the bank, that's just like a normal bank account where you can just go in, get your money out, no worries. The banks also offer fixed term saving products where you have to guarantee that you're going to keep it there for maybe a year or two, and that may or may not be suitable for you. And in general, the advantage of these are that because you're guaranteeing giving it to them for a year or two or more, then it will give you a higher rate. The cons are just exactly what we just mentioned, really. And I'm going to add in a slightly nuanced point as well, that some of these fixed term savings are for 5 years. And it's well, you could, if your individual circumstances are correct, you could make the argument that if you're going to keep it in the bank for 5 years, you might as well invest it, given that chart that I showed. But that is definitely not advice. Speak to your friendly financial advisor. Next way, store it in a cash ISA. So cash ISA, hopefully listeners of this podcast know about ISAs because we love ISAs. But basically, ISAs are what's called a tax-free wrapper, which basically means you put £20,000 in an ISA, which is the maximum amount in any 1 year, and that gains £10,000 in 1 year, you would not pay any additional tax on that. The gains inside the ISA are tax-free, right?
Yep, gains, absolutely.
Yeah. So, if you are affected by the interest payments that we talked about because of your earnings and the tapering down of that threshold, then a cash ISA could be a good option. Again, pretty nuanced point. If you're in the situation where you're an additional rate taxpayer and therefore you're getting stung by the interest on the bank interest, you could argue that you don't want to burn through your ISA allowance by depositing cash, and it would be better to use the ISA allowance for stocks and shares. What do you think about that?
Yeah, I mean, so as you say, if you've got a stocks and shares ISA, then all the gains are tax-free, all the dividends you receive are tax-free. Whereas if you've got a cash ISA, all the interest income is tax-free. But you're right, it really, as you say, as we keep saying, it depends on your personal circumstances. But if you're kind of rich enough that you're in that 45% tax rate anyway, you may want to be putting all your money into a stocks and shares ISA for the long term rather than use it for a cash ISA. But again, personal circumstances, I've got some money in a cash ISA because I'm going to be using that soon to pay my Help to Buy loan. And
Oh, you've
You
just
know?
done a spoiler. I was going to say at the end, what option did you choose?
Well,
Don't spoil it anymore.
I've got multiple options though. It's multifactorial,
Okay, right.
so
So keep
only
listening
part
because
of the
the
options are right.
YouTube algorithm likes you to keep listening and it doesn't like spoilers.
Oh, right. Well, keep listening because I'm spoiled it all. So
Okay, nice.
there's an incentive.
In fact, that's even more intriguing now because I'm thinking, what else have you done? All right. Again, highly dependent on your situation, really dependent, but you could do what's called a lifetime ISA. We've got tons of podcasts and YouTube videos about this, but lifetime ISA useful for it. Well, I wrote this one down, but I need you to talk about it. I mean, basically, yeah.
Yeah. I mean, so a cash LISA, so lifetime ISA, it definitely has potentially a place in your investment portfolio. Okay. Once again, because it's an ISA form of ISA, you will not pay any income tax on any interest you earn in that. Okay. It's got there are two uses for a LISA. Okay. Lots of rules about it. In particular, make sure, if you do want to set one up, you do it before the age of 40. That's really important because from your 40th birthday, you cannot set one up. Okay. So if you're below 40 years of age and you want to LISA, you can set one up. For every, let's say, £1 you put in, the government will put in 25p. Okay. So if you put in £4,000, which is the maximum you can put in each tax year, the government will top it up by £1,000. Okay. So every year, you can put in 4,000 up to into your LISA. Government will then put in £1,000, which normally comes in about a month or so later. And then you can use it for one of two things if you meet the criteria. One is to buy your first house. And the second is you can use it for retirement when you reach the age of 60. So if you're, it is a good, we're not here to give advice at all. A lot of people like LISAs because you're basically, let's say you're putting in £4,000, you're getting £1,000 automatically, which you can then get interest on or put it in a stocks and shares ISA. But of course, it's not particularly liquid. Okay, you can't just take it out whenever you want, unlike a normal cash ISA. So that is definitely a downside.
I thought about not including it on this list, but then I thought about that niche edge case where imagine you're saving for a house deposit.
Oh yeah, definitely.
It's literally designed for that.
Yeah, absolutely.
But
absolutely.
Yeah, you got to do your research there, consult a financial advisor, listen to our podcast on LISAs. Next one, premium bonds. Okay, so maybe you don't know about premium bonds, but essentially premium bonds, you pay, it's done by National Savings and Investment, which is a government, it's the government basically, and you store your money in there, £100, each £100 buys you a premium bond, and then every month I think they conduct some kind of lottery basically where one premium bond number is chosen to win. Is the top prize still £1 million?
Yep.
Not increased with inflation, I notice.
No.
Love it.
I think there are a couple of £1 million prizes.
All right. Yeah. So it's basically like your chance to buy a lottery. Again, okay, so pros and cons of this. Pros, you could win £1 million.
Yep.
Tax situation?
So any money you make from premium bonds are tax free. So if you win a prize, imagine you won £1 million, then you would pay no tax on that whatsoever. And there's no tax consequences of buying the premium bonds and no tax consequences of redeeming them either. So you won't pay any tax when you get your money back.
All right. Cons, I'm just going to put returns, okay? I was in a similar situation to you a couple of years ago where I had some cash in the bank because I needed to fix my house. I've definitely spent all of that cash now on the house and more. If anyone's done a house renovation, I know you know the pain. But anyway, the house is looking better. But my returns were absolutely dismal. At the first, I was like, oh, yeah, wow, I won £25 today. And then I looked at how much I had in and I was like, hold on a minute. That's like a 0.04% annualized return. Like, what? So, yeah. Cons, returns.
Yeah, cons and returns. The way it's meant to work is it's meant to be the prize rate, the way in which you win prizes is set in such a way that it's meant to match kind of like an interest rate for a savings account. So, strictly speaking, it's meant to be, if you put money into premium bonds, it's meant to be the equivalent of, I think it's at the moment, something like a 4.8% return, interest rate return or something like that. I can't remember exact numbers, but they've recently been increasing it in line with the Bank of England, interest rate rises. So in theory, your return should be a little bit like if you put it into a bank account, but with no tax on the interest. But as Tommy says, it is essentially a kind of lottery, to be honest. And, you may go through months where you don't get anything at all, or you might go every month getting, a small amount like £25, £50, £100,
Yep.
like that. So, strictly speaking, it's meant to have the same sort of rate. They change the price rates to match a kind of interest rate, but what you personally get can be very varied.
Yeah. I think this is like a classic case where you can know the numbers and what is the numerically correct thing to do, and then you add in emotion or your own personality characteristics or things like that, which are a really important factor in investing. And then that sort of out is what you actually do, because this is me. I'm a natural gambler, and so even though I sat there looking at absolutely dismal returns for 18 months, but I was just like, but I might win $1 million. So, yeah, it's like don't tell me what you think, show me what you own, basically. So yeah, I own some premium bonds. I use it to store my emergency fund. It's probably not the right place to store your emergency fund, to be perfectly honest, but
no, I think it's a very good place because you can redeem it fairly quickly.
well, yeah, it's liquid.
Yeah, it's really liquid, tax free.
Returns awful.
Returns for most people are bad, but as I say, it's meant to be decent.
Yeah, you know what? I've never played the lottery ever, so I kind of think of it as like that.
Yeah, here's a bit of a trivia for you. Do you know what the machine is called that generates the winners?
No, I do not, but you do, and this is ridiculous.
I don't know what it stands for, but it's called Ernie.
Ernie,
yeah. It's called it's an acronym or something, but the machine that picks the winners is called Ernie.
Love it.
There you go.
Wow. All right. So that's premium bonds. May or may not be a good option for you. I'm also going to add in something called fixed income bonds, which are again from National Savings and Investment. And this is like a fixed income bond, basically. So you give them some money and they guarantee to pay you that amount for a defined period. So I think a big pro of this is, I mentioned earlier, if you have money in a bank, you are protected up to a limit of £85,000 if the bank were to go bust. With fixed income bonds from the National Savings and Investments, there is no limit. It's just all protected, as far as I know.
Yeah, I think so. The National Saving and Investment people, they're obviously government. It's a government body, and their main raison d'etre is to essentially get money for the government to pay for their debt. So, I think that's quite advantageous in that sense. You mentioned, so I know I'm preempting you mentioned cons, maybe low rates, but actually I think they're not too bad. The government are quite intent or quite obsessed with getting as much money from us as they can to help fund their debt. So they've been asking the NSNI to make their interest rates more lucrative.
I mean, I'm not going to go on a tangent about how bond rates are set, but basically a bond, it's basically lending the government money. And because our economy is viewed as being absolutely destroyed, inflation running rampant, significantly higher than most of Europe and significantly higher than in the US, it's now quite risky to lend money to the UK government. And therefore, the benefit of that is you get higher returns.
Yeah, that's what we're looking at. I mean, it's still, we say it's risky. It's not that risky at the moment, they think. So, it's allegedly very safe to lend money to the government, is what most pundits would say. But you're right, the economy is not doing quite so well.
I want to do a podcast on inflation and everything like that, because I think you've got something to add there. But okay, we're getting into the weeds here, but the last two are quite big weeds, which, if this is niche, but if it fits your circumstances, it can be amazing. So the next one I've got for you is something called an offset mortgage. So this is quite popular. Where basically an offset mortgage, it works by, you can store money in the offset part of the mortgage, and that reduces the effective balance that your interest is charged from. So imagine you had a mortgage for £250,000 and you had £50,000 cash stored in the offset mortgage. You would only pay interest on a balance of £200,000, not £250,000. Now, these used to be really popular amongst GP partners, and inside our GP partnership course community, which has over 400 GP partners in it now, the next course is starting on September 27th. Apply now at medicsmoney.co.uk/GP course. Yes, got an advert in there. It might be sold out by the time this goes out. But anyway, have a look, apply, and if we think you're a good fit, we'll get back to you. Yeah, so it's quite good for GP partners because often they're self-employed and they have a lot of tax money ready to go to be paid out twice a year. And so it's actually not, it's quite an all right option. Historically, the rates weren't great, but recently I've noticed the gap has been closing because, well, I've been looking into it myself. I haven't done it yet, but I looked into it last time I remortgaged and it didn't make sense because the rates weren't as good on the offset mortgage. But this time they're getting a lot closer. So could be option. I mean, that is pretty niche. I realize that. And uber niche category at the end, something called money market fund. Okay, so a money market fund is a low risk but not zero risk investment. Okay, and I nearly didn't include it in here because we're talking about things that are basically really low risk or close to zero. But a money market fund is an investment, so it's a low risk but it's not zero risk. And basically, it's a great way to just keep cash, or can be a great place to keep cash. And how it works is instead of investing in stocks or shares or bonds, it invests in short-term debt, usually from governments or banks and companies with healthy balance sheets and high credit ratings. And then it plays a small return to you as interest. So it can be a stable, low-risk investment because the short time frames mean there's less uncertainty. And you could argue that it's slightly more diversified in holding all your cash at one bank if you're in the fortunate position to have more than 85 grand in one bank. But it shouldn't really be in this category because it is an investment. It is not, you could, investments may fall in value, basically, unlike a savings account. But as investments go, it's reasonably boring. And that's what you're looking for, really boring. All right. So I can't think of any more. Can you?
No, I mean, not really. This is just going a little bit, it's kind of related, but a little bit off topic. Because I know obviously we're talking about the idea of having cash that you might need to spend on something in the future. So we're keeping it liquid, etc. Just one thing to say, of course, if you do have some cash that you don't need to spend and you're, obviously we talked about, ISAs, etc., stocks and shares ISAs. Don't forget, of course, another thing you could do with your cash if you've got some is to pay down debt if the interest rate is high enough to need to do so. So just to point out, we're only really looking here at if you've got cash and you need to use that cash for something, what you can do with it. Okay, so just bear that in mind. There might be other things you can do with your cash if you don't need to keep it aside.
Great point. Goes without saying, if you've got a credit card with a 19% interest rate, paying down that credit card is a guaranteed 19% return. Okay, there's no other place that I know of you can get a guaranteed 19% return other than paying down bad debt. Okay, so if you've got credit cards, store cards, some car finance, etc., bad debts, they'd probably just get those paid down. I mean, really, what you could probably argue is you need a 1 or 2 months of emergency fund, which I know is your favorite podcast. But emergency fund is just a supply of money that if anything really bad happens to you, you don't have to. You've got a couple of months of your outgoings stored up. Once you've got a couple of months emergency fund, then pay down high interest rate debt, bad debt, and then you could consider building your emergency fund out to sort of 6 months or so. I mean, basically, because I'm self-employed, I have quite a large emergency fund, which is quite fortunate because I chopped my hand off recently. I'm not currently working as a doctor, which is a bit sad, and I will be back one day. But right now, if I didn't have, insurance, income protection insurance, and an emergency fund, I'd be in a bit of bother. But as it is, I can just focus on getting better, making podcasts, talking to you. So yeah, great point. Absolutely great point. I was going to say something else, but I've forgotten now.
Shall I say what I've done with my?
Yeah, good point. That was exactly what I was going to say. Yeah.
So as Tommy said, I do have some cash saved up because I've been saving as much as I can to try and pay off my Help to Buy loan, which I took out in 2018, and from August this year I'd have to start paying interest on. Which the first year, I'm sure there are a lot of people who listen here have got Help to Buy loans will know the first year it's 1.75%, which isn't too bad given at the moment what interest rates are doing. But anyway, I'm going to try and pay that off when I can. So I've been saving lots of money for that. And, in terms of where I've put it, it is quite spread out, to be honest. And maybe not the most tax efficient thing in the world, I'll be honest. But what I've done is I've put a big chunk of it into premium bonds. So you can pay up to £50,000 into premium bonds. We should have probably said that earlier. So there's a limit on that. And then
it's per person, right? So
per person,
yeah.
per person. So I'm on my own. So £50,000 just for me, or
Feel free to pay some into mine, and we'll split the winnings, right?
Okay. Well, I don't know the legalities of that, but I will see. Unless I can set some up for my cats, maybe that would do.
Or those baby hedgehogs that have just hatched in your garden. That was so cool.
Oh yeah. I've got a hedgehog's moved into my garden, and she's had 3 babies, which is quite cute.
Love it.
Yeah. So I put some money into premium bonds. I've only had that investment for 2 months now, and both months I've won a prize, but the prize has been £25 each time. So not huge amounts, but they nice to have and tax free. So I've got some money in premium bonds. I do have some money in a savings account that pays an interest rate. I think it's 3.3% at the moment. So I've got that as well. Very, very quick and easy to get the money out of that when I need to, which is what I'm going to be going for when I pay it off. I've got some in an instant access account, but no interest on that, but small amount. And I do have a bit of I've got a LISA, which I put money into. That's no help at all, as I said, from Help to Buy loan, because I can't get that money out until I'm 60, because it doesn't count for me to use that money for this house. And I do have a cash ISA, but I do, where I can, I'm hoping I can save up some more money later to put into my stocks and shares ISA, which I'd much prefer to maximize out for the long term. But yeah, so it's spread out over a few places, but all those places will be very easy to get that money out when I do end up paying off the Help to Buy loan.
Yeah. And similarly, like I said, I have mine in premium bonds, which has not been great for me, but it's liquid, it's tax free. I don't have to worry about any of those tax things that Ed talked about. Honestly, I'm actually looking around at some of these sort of savings accounts that are available at the moment, because the interest rate's all right.
Yeah. Some of them are like 5% odds.
Yeah. But basically, at any one time, I aim to be maximally invested in my stocks and shares ISA because of the charts that you saw earlier. But obviously, at the moment, I'm having to be slightly more cautious because my income is a little variable because I've chopped my hand off. But yeah. So none of this is advice. I've acknowledged that there's the numerically correct thing to do that makes sense, and then there's what we actually do, and that's just an example of how psychology influences your decisions. I know premium bonds returns have been awful for me. I'm going to look at up your 4% claims, but I'm a natural gambler, and I just I like it that Ernie might just spit me £1 million one day, but Ernie consistently seems to spit me £25, which is nice to have. I'm not complaining, but it doesn't make sense numerically.
No, that's true. But let's hope Ernie is kind.
Yeah. Okay. I hope that was useful. It's a slightly different style of episode. So let us know in the YouTube comments, A, if you've got any questions, B, if you think we've missed anything, and C, do you like these more kind of chatty, informal kind of style episodes where we go through what we actually do rather than the textbook way of doing things? Because this is quite individual for us and it might not apply to everyone, but I think enough will. And also, if you haven't, could you please leave us a review on your podcast player of choice and just write a short review, because it helps other people to discover the podcast. We are coming up to 1 million downloads of the podcast now. And that's the good news. On YouTube, we are, I think, around 2,500 subscribers. So we need to do a bit of work on YouTube.
Fair enough.
Which we are. We're releasing loads of new videos on YouTube about investing and more this kind of chatty kind of stuff, actually. So head on over to our YouTube channel. Thank you so much for listening. Have a good day wherever you are heading off to, whether you're on the way to work as a doctor or healthcare professional. Thank you so much for what you do, especially because you're helping patients like me. And if you're in the gym or something like that, well done. I haven't been in the gym for a while, but I am back on my exercise bike doing Zwift with the hand, which is just amazing after 9 weeks. So I didn't think that would happen. But yeah, Zwift if you've ever done Zwift, you know how hot it is, and it's the summer. So basically, everyone does Zwift in the winter. Mm-hmm. I'm doing it in the summer. So on Zwift, it's just me and a load of Southern Hemisphere people. Everyone's from Australia or South Africa or Japan, and it's absolutely boiling. So
I have no idea what you're talking about, but it sounds good. And yeah, keep it up.
I think that's it, mate.
Yeah. Cheers, guys.
Yeah. I think that went all right.
Yeah, that was good.
Cool.
Wait, the Zwift. Is that the thing you're doing on your Mac with the bike?
Oh, how do I stop this thing? Yeah, it's cool. It's like I can't explain it, but it's like a computer game for biking. So you actually bike, and then yeah, it's really good. I mean, it's because I can't ride on the outside world at the minute.
Yeah.